Hello students, today we are going to study about arbitrage pricing theory. What exactly arbitrage, its equation and assumptions. The arbitrage pricing theory, before going to that, arbitrage, what exactly it is. For example, this is utilizing the differential markets where you purchase an asset in one market for the lesser price and you can sell in other market for the higher price. That is called an arbitrage. So this theory, arbitrage pricing theory, is an alternative to the capital asset pricing model that we have already seen, that is CAPM. It was developed by economist Stephen Ross in the 1970s. Over the years, arbitrage pricing theory has grown in popularity for its relatively simpler assumption. So, however, arbitrage pricing theory is a lot more difficult to apply in practice because it requires a lot of data and complex statistical analysis. But this is the extended version of CAP. So how actually APT works? It's a multi-factor technical model based on the relationship between a financial assets, expected return and its risk. So here two things value. First is the return and risk, and it explained the relationship between the financial assets. The model is designed to capture the sensitivity of the assets return to changes in certain macroeconomic variables. So always due to some macroeconomic variable, the always price changes. So this theory takes these consideration, the variables of macroeconomic, the factors, and take for the calculation. Investors and financial analysts can use this result to help price securities. So coming to the assumptions of these theories are, so first assumption, unlike the capital asset, before going to assumption, unlike the capital asset pricing model, arbitrage pricing theory does not assume that investor hold efficient portfolio. But we have studied in CAPM that investor hold an efficient portfolio. The theory does, however, follow three underlying assumptions. First, asset returns are explained by a systematic factor. That is the first assumption made by the APT. And second assumption, investors can build portfolio of assets where specific risk is eliminated through diversification. So again, that is the second one. Here he assumes that one particular specific risk which is associated with the portfolio that can be managed through the diversification of the portfolio. No arbitrage opportunity exists among well-diversified portfolio. If any arbitrage opportunities do exist, they will be exploited away by the investors. So that is how the theory explains with its assumptions. So this is how the theory got its name, that is arbitrage. Because here everyone knows, if anybody comes to know about the arbitrage opportunities existed, so if they come to know, they will exploit it and they use out with the investor. Now coming to the equation of arbitrage, the expected return of portfolio is calculated by RF plus beta into Fn plus B2 into F2 plus go on plus Bn into Fn. So RP represent expected return and RF represent risk-free return. Bn represents sensitive to the factor of n, and the Fn represent nth factor price. So this is how the formula we take for calculation by using arbitrage pricing theory. The problems we will see in the class, offline classes, this is all about theory. Now coming to the difference between CAPM and APPT. So first, if you take the factors considered during the calculation and simplicity, in CAPM, one factor is considered, the expected market return, that is we call RM, return on RM. So this makes it more simple to use when pricing an asset. But when it comes to APT, here we take multiple macroeconomic factors that we have seen in the theory or company specific factor that require different beta. So this makes it hard to use when pricing an asset. But when it comes to CAPM, it is very easy to calculation. Coming to next, time used to determine asset price. Less time since we use one beta, one factor in CAPM. So, but in APT, additional time and effort are needed to determine the factors and quantify them and calculate which beta to use in relation to that factor, because here we are using multiple factors of to calculation. Accuracy of the results. Fewer factors are equivalent to less accurate. So due to the nature of its factors, CAPM can cause a lot of inaccuracy for small stocks and value stock. So CAPM also makes a lot of assumption. For example, it assumes an individual can borrow and lend at a risk-free rate. But when it comes to APT, it was only not only developed as an alternative, but also an extension of CAPM, making it more accurate than CAPM. But also more factors are equivalent to a more accurate prices. Coming here, we can say APT is more accurate than CAPM, but it is very lengthy to calculation, and here multiple factors are taken. But when it comes to CAPM, it's take only one market return. Now, coming to the practicality and ease of use, the only factor considered is the market risk premium, which is easy to calculate and more practical since the market keeps changing fast. But when it comes to APT, time taken when computing the beta and risk associated with each factor accuracy may not be practical to give the ever changing aspects of the market and the factors themselves. So these are the main difference between CAPM and APT, where APT is more accurate compared to CAPM, but factors taken and calculation time is huge in APT compared to CAPM.